Is Walmart finally cheap enough to buy? The stock has been an amazing compounder since its inception, returning 146% gains to investors who bought back in 2010, not including the dividend or the share buybacks. However, this stock has dropped 17% since the highs back in April. So we have to ask ourselves, is Walmart a worthy addition to our portfolios? Will this earnings release prop the stock higher, or will the stock continue to decline from these levels? Keep watching to find out as we're talking about that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. With that being said, today we're going to take a look at Walmart's Q1 2023 earnings results, where we'll do a deep analysis into the financials here. We'll also take a look at the technical setups to see what exactly is setting up here with Walmart. And as you can see, we are down 17% just over the last few months. We'll talk about that in just a second. And then we'll conclude with the valuation of this business to see whether or not we as retail investors should be including Walmart into our portfolios. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. All right, guys, so let's quickly run through the technical setups here for Walmart. Okay, and if we stretch this chart all the way back to, pretty much inception, what do we see here? It's just consistently gone higher and higher and higher, guys. And that's exactly what you want to see from an investment or a potential investment, because typically the trend will usually continue unless something changed with the underlying business. And in Walmart's case, I don't believe that is the case. So what have we seen over the last few years with Walmart? We've clearly pushed higher, breaking through resistance points time after time again. Every time we fell, we'd fall into some old resistance points, as you can see here, and then they would become support and prop the stock higher again and again. So now we're up to this point where now we're up to, $150, $160 per share, but now we're finding extremely tough resistance at this point, and we haven't been able to push through it. Okay, so ultimately what happens now is the stock is rejected lower, and hopefully we'll find enough buyers down here to help lift the stock higher once more. But as you can see, Wall Street really didn't like what they just saw from this earnings report, and the stock has ultimately crashed quite a bit, from up near $150 per share at the start of this week to now $131 per share, which if you check this percentage right here, you can see is an 11% drop just for this week alone, and it's due to this earnings results that just came out. We'll get into those numbers in just a second, but what you need to know from the technicals is that we're in a key zone right now. This green zone here is going to hold this stock up as it has since about, let's say, September or August of 2020. So let's see, we need to see, is this zone going to hold up once again? If not, guys, we can expect lower prices down to, $118 per share, which for you value investors actually wouldn't be the worst thing ever, because then we could come in here and potentially pick up shares of Walmart for a very nice discount. But stick around to the end of the video to see at what price point we actually would like to buy shares of Walmart for. That being said, let's jump into the earnings highlights and digest what Wall Street saw from these earnings results. All right, guys, so let's look at the earnings highlights here. And right away, what do we see? We have revenue that came in at $141.6 billion. This is actually up 2.4% year over year, and it beat analyst expectations by about $3.5 billion, which is a solid. On our bottom line, we saw earnings per share come in at $1.30, which actually missed analyst expectations by about 18 cents. And then our outlook they provided for the fiscal year of 2023, they expect net sales to tick slightly higher, while earnings per share will be flat. So guys, ultimately what we're seeing here is that while top line is beating and is up, let's say 2.4% year over year, earnings per share and bottom line is missing the mark and is ultimately what is dragging the stock lower. Now, the management did mention that they had a good quarter from the top line point of view. However, from the bottom line, they actually were expecting a lot more, and they said that this is primarily due to three negative aspects that came out of Q1 for 2023. The first item they said was their wage expense. They had hired extra staff to deal with the viruses, but then they hired too many and they became overstaffed. The next item that they had here as an issue was that they had higher costs for containers and storage, which is never a good thing, but they did mention that these costs should come in a little bit for the rest of the year. And then the third thing is that they had fuel costs that were actually exceeding their expectations once again by actually over $160 million for the first quarter than what they had initially forecasted. So again, those are the three things that are really weighing on the earnings per share figure. And it's what Wall Street did not like. If we actually go over here to the financial section, guys, we can actually look at this from a year over year perspective. So we had total revenues, guys, coming in here. It's actually up 2.4%, as we just alluded to, $141 billion for this quarter. Okay, they had cost of sales on that revenue of $106 billion, which is kind of steep. And then when you tack on operating expenses, SG&A, etc., about $30 billion, we're left with operating income of only $5 billion off that $141 billion in total revenues. Ultimately, this is actually down 23% year over year. We had $7 billion last year, but now we're down to $5.3 billion. And they mentioned that the divestitures in the business are the result of the decrease here. Okay, if we add in our other expenses here, we come down to a consolidated net income attributed to Walmart of $2 billion. Again, down 25% from last year where we had $2.7 billion. So guys, not looking good so far. And if we look at this from a GAAP perspective, we're looking at about 75 cents in earnings per share for this quarter. Last year was about $1. And if we look at their cash versus debt figure here, they had about 11 billion, let's call it $12 billion in cash, but they actually had about $50 billion in debt when we calculated for the portions of long-term debt that was owing within the near future. And then they also had long-term debt, which was a pretty high figure. So as you can see from this graphic right here, our cash is about 12 billion, where our debt is about $50 billion. That's not what you want to see from a typical investment, because you want to be able to see that this business can actually pay off their debt within 1 to 3 years, let's say, using the cash that they have. But obviously with Walmart, that's not really the case. So that's something to note if you're thinking about Walmart as a potential investment. They do have a lot of overhead debt sitting there. Okay, let's move on to the cash flows here. And what do we see? So take down our net income figure here of $2.1 billion, add back in depreciation, amortization. They don't have any stock-based comp from what I can see here, which is a plus. And so we come out actually with negative cash outflow of $3.7 billion for cash used in operating activities. Again, guys, this is a really bad quarter for Walmart. And as you can see, just 1 year ago, we actually had about the opposite, about $3 billion in positive cash provided from operating activities. So for our calculation, we will be using last year's figure, but let's proceed and see what they did with these cash flows. So we deduct our capex. We're already at about $7 billion now in cash outflows. What else did they do? Naturally, because they had a cash outflow here, they're going to have to take on some debt. So they took on about $11 billion in short-term debt. Okay, they paid down a little bit of their long-term debt. They also paid a dividend because they are paying that as well. So that's something to note for your investment. $1.5 billion for this quarter. So you can extrapolate that they'll pay you about $6 billion worth for the year in dividends. And then they repurchased some shares as well, $2.5 billion worth. And that sums up what they're doing with their cash flow, guys. So it's not really going to be able to help us here in terms of evaluation. So we'll have to check out the historical results and come up with a figure that we can use to evaluate this business. All right, so looking at our summary tab here, guys, these are just going to be our metrics to consider when we think about adding this as a potential investment to our portfolio. Okay, we have gross margins of about 25%. We have operating margins of about 4.5%, which, guys, is a little thin. But when it comes to retail stores and grocery stores, you can expect thin margins. Next we have here is our return on invested capital, which is 10%. That's actually pretty strong for Walmart, and is why this is actually a good candidate as something as potential investment for the typical retail investor. Okay, we have free cash flows down here. We have operating cash flows typically coming in at about $25 billion per year. Then we deduct our capex of about, let's say $14 billion. We're left with free cash flows of about $11 billion per year. Okay, we add on our dividend yield of about 1.5% plus our average share buybacks here of about 2%. That all adds on to your investment. So guys, with that being said, let's jump into our calculator here to see at which price point we could actually come in and pick up shares of Walmart for a margin of safety. So let's just jump into the historical results before we put an evaluation on this business, just because this was a bad quarter for Walmart and we're expecting Walmart to rebound from these levels, as is the management. So just for simplicity's sake, let's use the earnings per share and the free cash flow per share figures here for our potential investment, guys. And if we look back at these historical results, we can see they were at $5, flirting around there. They went down to $2, then rebounded once again back up to $5, $4. So if we can accurately estimate this and give this a conservative estimate, we can give them about $4 in earnings per share on a yearly basis as a conservative estimate as to how much they can accurately produce over the next few years. Remember, they reported about 73 cents per share for this Q1, although they did say it is going to be lower for this quarter than it is going to be in future quarters, and especially when we get to Q4, we should see a nice increase there. So using that $4 figure here as a conservative estimate here for Walmart, if we put a 10% required return on them, they do pay a dividend here. If we expect for them to grow at about 8% over the next few years and then 5% the subsequent 5 years on a 20 PE, we would actually be looking at about $95 per share as an expected case for Walmart. And that's not great because the stock price is currently up near $130 per share. But in our optimistic point of view here, growing at 12% for the next 5 years, 8% for the next 5 years after that, on a 25 PE, we could be looking at about $143. So that's a little better. But this is really where you have to change your thinking on investing, okay? You have to understand we're looking for a required return here of 10%. Now, if we wanted less than 10% return per annum on this investment, we could definitely do that and drop it down and pick up shares of Walmart for a cheaper price. If you're looking for, let's say, 7% return, then yeah, $118 per share would be a great price point to pick up shares. And again, we talked about this during our analysis, our technical analysis here, right? We could see Walmart at $118 per share very shortly, considering we are dropping quite hard at this moment. And if we rebound off these levels here and continue lower, this is the next price point that we're going to touch. So at that point, you would be looking at about a 7% return on your investment. You would be also collecting dividends. You would also be receiving the benefits of share buybacks as well. So this is all adds up. And then in the best case scenario, you would actually be looking at a nice upside to up to $180 per share, which would be all-time highs. So that's why for me, guys, Walmart actually is looking like a pretty good investment, especially if we can come in there and pick it up at about $118 per share as our intrinsic value calculation, as I believe this would be a great price point to come in there and pick up shares of Walmart for myself. That being said, I do want to see it drop down a little more, closer to this midpoint here of about $120, $125 per share, around there, before I even act on it, because I do want to reap the benefits when this stock eventually continues higher. That being said, that is my analysis for Walmart's Q1 2023 earnings results. If you like this content and you want to see more, please press the like button and hit the subscribe button as well, along with the bell icon so you can be notified when we post. And with that being said, I'll see you on the next one.